This is Cece. Welcome to The Orbit. It is Income from Options Weekly, where we start off the week. We look at the setups for credit spread traders in general. But let's just start with what the SPX and what the market is doing this morning. We talked about it a lot on The Orbit last week. Into monthly Feb expiry, there was a lot of gamma, particularly around that 5,000 level in SPX, that the chances for a 5,000 or a roughly a 5,000 pin or stop on expiration Friday were very high with all that gamma. You'd see sellers above the 5,000 level and buyers below the 5,000 level. We also talked about how once that cleared, you might get the next indication, the next move in the market, or at least see the market open up a little bit for some intraday and day-to-day volatility. And that is probably what we're seeing a little bit here after the 3-day weekend. Traders came in. They are sellers of stocks this morning. You look at some of the high-flying names like NVIDIA and SMCI. They are down today. More on that in a second. But just sort of an indication of that gamma and what we've been talking about on the orbit. And this is not going to reset anytime soon. You have to, the options market in the gamma backdrop would take some time, and you could see it go the other way. You could see traders start to reach for puts. We have seen some indications of traders reaching for upside calls, particularly in some of these high-flying names. And that could take the VIX and it could take general vol higher. This is Income from Options Weekly. And so we are looking at a 0.4% expected move for today. For the week, we are looking at about a 1.1% expected move. And this vol is about 16, which is higher than we've seen it. It's like the 16, 17. This is a vol pop. We were about in the 12 to 13 range for a couple of weeks, and that's another indication of this gamma clearing, right? It allows the market to breathe a little bit. It also allows the options themselves, premium-wise, to breathe a little bit. They are no longer just getting hammered into an expiry with sellers. So that's so now let's talk about NVIDIA and some of these high-flying names, because you're hearing a lot about how important NVIDIA's earnings are. You get this a lot in financial media, is, a lot of hype into some big, trendy companies' earnings. In this case, there might be some truth to it. And it's not from a fundamental standpoint that, people are going to be poring over the numbers of NVIDIA and seeing if, what the next leg in the market based on the earnings are. It's more of a vibe check for the market, if that makes sense. It's tough to imagine some of these parabolic moves that we've been seeing, and SMCI is probably the poster child for that, but you're seeing it across all these AI and chips. Are we about to hit some sort of bubble where any company that mentions some AI initiative immediately goes up 50%? It's hard to imagine SMCI and some of these other names making these parabolic hockey stick moves without NVIDIA. We also have FOMC minutes this week. Let's just go on the weekly. I want to kind of look at the trade setup for the weekly Condor, and wanted to do it more as to kind of trading levels and all. So obviously we're looking at a Condor expiring out to Friday. If you look, this 50-30 level, this is a little bit lower than these highs. So one of the first things I would be looking to do is to see, if we went closer to 50-45 up near that 50, with the break even up near that 50 level. And then if we did the same thing here to the downside, and we sort of took this down where, let's say our short strike is 49.05, and now we've cleared some room. We've given ourselves some room. So if if this turned into 2 days in a row and tested this level, this low from a couple of days ago back here, we'd give ourselves some room. We wouldn't get stopped out. We wouldn't get that freaked out on our short strike. And the same thing, if we bounced, if there was a turnaround Tuesday, or if NVIDIA ripped and carried everything with it, like the Qs and the SPX, with it. We got back near these highs. We give ourselves some room to make a decision on this trade. Now, the same thing is true for 0 DTE style trading. If we were looking at a credit put spread, let's say, if we were looking at a credit put spread, obviously right now the levels for would be about 49.50. Perhaps, perhaps that makes sense on a 0 DTE day. You're already down almost 0.7%. The expected move coming in wasn't even 0.5%. You are using the market's intraday momentum to sell at the 20 or 25 delta level down here, when coming into the day, that only had about a 10 or maybe even a single digit probability of happening. And so that's one way that traders look at that sort of thing. The other way traders might look at this is if you got any intraday bounce, you might be looking to sell a credit call spread back towards the unchanged level. And the idea being that, you do not see many reversals where you go from this far red to all the way green. It happens, but it doesn't happen that often. So some traders like to trade that way, or they do it based on the 2-day expected move. And perhaps if the market did rally, then all of a sudden you have an opportunity back up in this area. So